Hi, we're from University-Mankato, and my name is Jeff, this is Lado, and this is James. And quick, we're just going to go over the company overview and just a quick highlights of Graco. So Graco just recently sold their liquid finishing business on October 8th for about $570 cash net proceeds. We believe Graco has a very extensive product line with over 40,000 SKUs. Graco is a very stable operating cash flow model. As you can see up there on the right, the 52-week range for Graco has been around $65 to $82 a share. Currently, Graco is trading around 75. And just a little bit about Graco. Graco was founded in 1926 in Minneapolis, Minnesota, right here. Graco is in three operating segments. We have an industrial segment, contractor, and lubrication. As you can see, the industrial segment for Graco is the largest with 59%, followed by contract and lubrication. We can look at the average units sold per day. We can tell that Graco is a low volume, high mix type of company, and that's our operating model. Operating segments, just to go a little bit further into it, we have the industrial, which kind of focuses on automobile and airplane manufacturers and like the food industry. We have the contractor segment, which is kind of felt like your private contractors, and recently they entered into the do-it-yourself industry, so you can buy like maybe loader staples. And then they also have a lubrication segment where they do a little bit more industrial lubrication different services. Graco is 80% of their productions is located here in Minnesota. They are located globally, and with that 80% production in Minnesota, they can leverage a really highly skilled workforce. Currently, our recommendation for Graco is a hold. We'll get into that further. Target price is $76.40. That was a 1.8% downside from January 13th of the report due date. Why we think Graco is a great company, we'll go on further. We think recent price growth in the stock outpacing the S&P 400 mid-cap, and then slowing economic growth has kind of taken a little bit of a toll for it. And we'll move on to industry and competitors. Wow.
A little bit about the industry that Graco is in right now. It's a machinery industry. The current trends are the cost reductions. We see a lot of measures in global expansion, as well as we see rising raw material costs such as copper. And this caused the companies to lower their profit margin, and this initially caused higher manufactured product price. As you know, Graco is big for their leading innovation and product development. They invest in research and development 3 times to compare to their peers. That is depicted on the graph as well. Graco is known to work closely with their customers, and then they develop a highly customized product and then for their customers. Some of their competitive advantage is that they own 58% share in the $500 million contractor market, while keeping their labor costs 6 to 7% of the whole cost of goods sold. They have 100% ownership of all their 37 subsidiaries, so that's a little competitive advantage for the company as a whole. If you look at the competitors, some of them are Illinois Toolworks, IDEX, Caterpillar, and Deere. Another competitive advantage is that they have over 40,000 SKUs, stock keeping units. And they are low volume, high mix operating model, and then it's difficult to replicate for the competitors. So this gives them advantage. It has with that model, it's for the customers. They have high switching costs from product to product, so they would stay with Graco. I want to touch base on the recent divestiture of Graco. They purchased the liquid and powder coating assets of Illinois Toolworks. However, after the Federal Trade Commission enforced some rules and regulations, they had to sell their liquid finishing business, and they sold it to Carlos Lee Company. And the important factor here is that CEO of Carlos Lee is Dave Roberts, who is ex-CEO of Graco. So right now, it increases the competition in the industrial segment. However, after speaking with the management team, Carlos Lee needs 10% higher operating margins to be competitive, and this will be only achieved through reducing the cost and doing some growth, revenue growth for the Carlos Lee Company, so it will be a top. We also did 5 force analysis, and the most important thing here is that the threat of new entrants is really low because of their high barriers, and then threat of substitute products is low because Graco is doing so much in research and development, and they have high product quality and a customizable product. And I want to kind of give it to James for an evaluation of the company.
For the valuation of Graco, we gave a price of $76.40, and we used the discounted free cash flow to the firm method. With that method, we valued Graco over 5 different phases. This varies from the growth phase down to the sell-off phase. And the growth phase, we used that for 20 years. And the reason why we use 8.64% is this is what Graco has done with its operating cash flow over the last 10 years. And then we can see how this progressed, like just over the typical company over its life cycle, how there's slowing growth, stable, and then eventual liquidation. We chose a lifespan for Graco of 43 years because we found that the average Fortune 500 company lasts only around 40 to 50 years. And we discounted the operating cash flows using WACC, and we found that the industrial segment was very valued at $64. And just one thing to note is industrial does have the highest value relative to the other segments because they have the highest profit margins as well as the highest recent growth in recent years. We would like to make note about their growing sales volume. Much of Graco's growth is related to the macroeconomic conditions. We found that their volume growth over the past few years has been around 3.5%, and so we projected that forward. There has been a drastic change in the product mix over the past decade, but we do see a strong correlation with sales volume and the world GDP growth, so we expect that to continue. Some of the valuation components that we used was the operating cash flow, and then we found the depreciation rate and taxes to be the same moving forward. That's because during the past decade it's been fairly steady and hasn't changed much. For WACC, we found a return on invested capital of 3.25% for cost of debt, that's after tax, and then also 14.83% for cost of equity. This came out to a weighted average of 9.94%. And we have a display here of the breakdown of how we calculated WACC. Just kind of a brief overview of the Graco's debts. They have 4 main issues at $75 million each. Their average rate after tax was found to be 3.25%. And then we have the breakdown of how we found the cost of equity. We used the CFAMN model for that. We found the risk-free rate to be 2.3%. This is based on the 10-year U.S. government bond rate. And then we also found the market risk premium to be 9.5%. This is based off of the S&P 500's historical return since 1956. We also use a beta of 1.73. This is based on Graco's 3-year monthly price change relative to the S&P 500. And as you can see here, that came out to a cost of equity of 14.83%. And then we have a breakdown of how the cost of debt and equity relate to each other relative to their size. Long-term debt was 42%, and paid-in capital came in at 57%. So breaking in the cost of debt and the cost of equity with their weights, we came in at 9.9% for WACC. And now we have here is a relative analysis of Graco relative to some of their competitors. We found that they're relatively the same. Graco kind of fits right in the middle. We would like to note that the dividend yield for them and their competitors was about 1.5% to 2%. Compared to the S&P 500's 55-year historical return, the dividend yields should maybe be higher, so the industry as a whole may be overvalued. And now we'll go into the financial analysis part. We did find Graco to have consistent growing free cash flow, and it was backed by 86% from the operating cash flows as a percent of earnings before interest and taxes was found to be 87%. And we did find rebounding demand to help Graco quite a bit. And foreign activity is found to be 113% growth over the past few years compared to domestic earnings of only 28%. And they've had much industrious growth over the past few years.
Right, we can do a quick risk analysis. We can't really make it through all of them. So we find some competitive pressures. We like to point out Graco's got a pretty good spot competitively to a lot of people. Graco has some growth strategies in the future going forward. However, with some M&A activity recently, it's kind of caused concern. And we believe Graco is really tied to macro environment conditions such as their GDP growth rate and so on. And again, we would like to reiterate our whole position.
questions?
I just, one of the questions I had for you is, one of the things that we concentrate a lot on in our analysis of other companies is the quality of the management team. And I'm assuming that during your analysis of Graco, you spent a little bit of time doing that as well. Can you talk through to me how you went about doing that, and kind of talk a little bit about the quality of the management team for Graco, and how that kind of factored into your evaluation and risk analysis?
Yeah, that was one thing when it comes to our risk analysis. I guess we almost really portrayed right there. It's just we think Graco's been around for a long time, and a lot of the guys in the management team have been in it for a long time, and a lot of them they understand the industry. They're pretty into it. And we didn't see a whole lot of risk with the management team itself, and that's kind of why we didn't really touch base on it a whole lot. We like the management team for Graco.
I'd like to have a question on your financial model. You've got operating margins expanding here from 2014 up to 2019 and 20 by a decent amount, even though they've been static to declining more recently. Just wondering what the drivers of that margin expansion and what would be the biggest factor to cause that margin expansion in this year's estimates.
Okay. We looked at the operating cash flow, how it's been for over the past 10 years. So we kind of make a note that the economy projected forward for the next year, so it doesn't look so great. But looking over the long term, the economy's moved forward, Graco's moved forward. They've had many bumps in the past, so looking back at 2009, there was a hit, but at the same time, they recovered with the rest of the economy. So we expect that to be the same moving forward.
You pointed out the disposition of the liquid finishing business. How do you contemplate on the sale of that business in your outlook for the company? What kind of adjustments, if any, did you make in considering valuation?
In our valuation, we took it was around $115 million deduction with debt payoff over the next 3 or 4 years. And then some of that leftover cash, they have right now about $800 million of immediate cash available. So after paying off some of their debt over the next 3 or 4 years, we had some extra leftover cash for acquisitions, which they have done recently. And we expect for them to continue targeting acquisitions that create synergies.
You cited that their product development expense ratio is nearly 3 times the level of their peers. I was just wondering, given that their revenues seem to be GDP type growth, where does that extra R&D expense manifest itself in the financials, whether it's through higher than peer operating margins, or is there some type of latent growth driver that we should be aware of?
Like you said, they have much higher operating margins than most of their competitors appear, so that's where they have to have a lot into their R&D expense to keep that product catalog, what they have, the low volume, high mix. And that's kind of like, especially not in the industrial segment, they have, over 40% margins in that really segment. So.
One of the things that we spend a lot of time with is the proxy statement. And so can you talk about management's compensation and what are the metrics that their compensation is based on in terms of short-term but also long-term comp, and how that factored into your analysis at all?
We did look into the management reports on what it was, and we found for the management's compensation relative to what they own, it's about 1.2% relative to total stock market share for Graco's common stock.
Do you remember their metrics that their bonuses were tied to?
I do not, but I would imagine to performance and how well this common stock is doing.
Can I ask one other question? One of the things that struck me in your presentation is that you said they have 40,000 SKUs, and you view that as a competitive advantage.
Right, like if, let's say that they lose 100 products to another competitor, they still have over 39,000 backing them up. So it like lowers the risk of a few products coming back, but it's all a lot going for them.
But the next step would be, that leads to a very high cost structure in the sense that they have to carry a lot of inventory and things like that. So how does that factor into, that's a competitive advantage?
After talking to the management of the company, they mentioned that one of the competitive advantage was over 40,000 SKUs, and that with a low cost, high volume model, the business model that they use, kind of blending these two together, they come to a conclusion of being a competitive because they're low cost, as you said, they have low cost and high volume. So that kind of plays into it.
To go with your question, I think a lot of the SKUs, a lot of the parts are interchangeable with each other, so they kind of maximize that with their operating efficiency. So like you can use the tube for one part to another tube, and so they can kind of use the same parts for a lot of the SKUs. So.
In terms of your growth assumptions, I think you have 8% in your growth phase. It seems like the company has been much more acquisitive more recently, and I'm just wondering how that affects the quality of the earnings going forward and your willingness to pay for those earnings streams if they're less dependent on organic internal growth and more dependent on acquisitions.
If they're more dependent on acquisitions, that may be more difficult moving forward just running out of acquisitions. So with the recent debt issuance for the purchase of the liquid finishing business, something to repeat like that may be difficult. So, but that's something that they've been doing also in the past. So we project that their operating cash flow would continue at the same rate.
Can you talk a little bit about Graco's competitive advantage, how you guys rate it, a little bit more detail there, and how that factored into your relative multiples that you use in your evaluation?
Can you repeat the question?
Yeah, I guess you guys did a Porter-side forces analysis, correct? And can you guys talk a little bit, probably a little bit more detail about the outcome from that, kind of what the purpose of that was, and how that factored into your evaluation, if at all?
Well, we did make note that with their lower products they have to produce, we just wanted more of a qualitative analysis. So we looked at the numbers, and so based on their past operating cash flow, we projected that forward. So it's just more like management quality, just sort of like a qualitative thing. So, yeah.
Graco has operations all around the globe, and yet they do not hedge their currency exposure. Given that the dollar is down over the last several months, what do you think about that policy, and did you incorporate that into your valuation analysis?
We have a sensitivity analysis based on the world GDP, and so we didn't incorporate the dollar, but this is a short-term thing, like a forward year. So long-term world GDP growth over the past 10 years has been a little over 6%, and with more and more of their sales exposed overseas, we view the dollar being a less important factor in the valuation.
So companies have a lot of things that they can do to grow their cash flows, whether it's going into new markets to drive sales growth, or there's internal levers that they can pull to expand margins and rationalize operations. So during the course of your analysis, what ideas did you guys have, or if you're having a one-on-one meeting with management that you would suggest, we think you guys should move into these markets for these reasons, or we think that you guys can reduce your cost structure by doing this. Did anything jump out at you?
Answering that question, anything that in particular that jumped out, not considerably. What was interesting, like what management was talking about with their growth in China, is they kind of looking more for your overseas market. So in your contractor business in the U.S., it's their sprayer division that it's like a 90% market share within that. So it's real saturated here. So it'll be going forward. It'll be interesting to see how it does overseas and like China. So I mean, I guess with me, I would express maybe a little bit more overseas in China.